Hey, I hope you're doing well today. Today I'm going to discuss how mortgage interest rates work in relationship to the economy and treasury bond yields, which greatly impact mortgage rates. So whether you're a first-time homebuyer or you're considering refinancing your existing mortgage, understanding how interest rates are determined is absolutely crucial. So in this video today, we're going to explore how the economy and treasury bond yields impact mortgage interest rates. It's important to note that banks borrow money short-term and they lend long-term. So when yields are higher in the short term than they are in the long term, that is a recipe for disaster, which is actually what's happening right now. Anyways, we're going to dive into it, okay? So mortgage interest rates are the cost of borrowing money to purchase a home. Lenders use a variety of factors to determine the interest rate, including the borrower's credit score, their income, and how much money they're putting down. However, one of the most significant factors that influence mortgage interest rates is the state of the economy and specifically the yield on treasury bonds. Now, treasury bonds are a form of debt issued by the federal government to finance its operations. Investors can purchase treasury bonds, and in return, they received a fixed rate of interest over a specified period. The yield on treasury bonds reflects the overall health of the economy. When the economy is strong, the demand for credit increases, and investors are willing to accept a lower interest rate on their investments. But the double-edged sword is when the economy is weak, investors demand a higher yield to compensate for the increased risk of default. The yield on treasury bonds also influences mortgage interest rates. Mortgage lenders use the yield on the 10-year treasury bond as a benchmark for setting interest rates. This is because mortgage loans typically have a lifespan of 10 years or more, and lenders want to ensure they earn a profit over the life of the loan. If the yield on the 10-year treasury bond is high, mortgage lenders will increase their rates to maintain profitability. Conversely, if the yield on the 10-year treasury bond is low, mortgage lenders can offer lower rates to attract borrowers. Now, in addition to treasury bond yields, the Federal Reserve also plays a role in setting mortgage interest rates. The Federal Reserve, what they do is they control the federal funds rate, which is the interest rate that banks charge each other for overnight loans. When the Federal Reserve lowers the federal funds rate, banks can borrow money at a lower cost, which leads to lower mortgage interest rates. On the other hand, when the Federal Reserve raises the federal funds rate, banks increase their rates and then mortgage interest rates rise. So the bottom line is understanding how mortgage interest rates work, and it is essential knowledge if you're considering buying or refinancing a home. The relationship between mortgage interest rates and treasury bond yields is really complex, but keep an eye on treasury bond yields, and the overall state of the economy can help you make informed decisions about your mortgages and your purchases. I hope you found this video helpful. If you have any questions, feel free to leave them in the comments. If you're looking for a realtor in Las Vegas or Southern Nevada, my contact information is below. Shoot me a text, give me a call, send me an email. I'd love to connect and see how myself and my team can help you. If you have any questions about mortgage rates, drop them in the comments. You can also check out Chuck Barone's show that he does daily. He is a mortgage lender and he can answer questions you have as well. I hope this information was useful to you. Again, if you guys have any questions, go ahead, drop a comment. Go ahead and like this video if you found this content useful, and share this with somebody who might not understand how mortgage interest rates work. As a bonus, go pull up the 10-year treasury bond yield chart for the last 30 years, and then pull up the 30-year fixed mortgage chart for the last 30 years, and you will see it ebbs and flows in unison, like they're dancing together, okay? And you will see as the rates go up, the yields go up, the mortgage rates go up, all right? Hope you guys have a great one. Take care. Until next time, I'm Jordan Dove. See ya.